Hello and thanks for joining this video. What we're going to be looking at today are the benefits of owning property or building a portfolio in the UK through a UK limited company versus doing so in your own name. So we'll try and keep it short and sweet, about 5 minutes. Please forgive me if it's over. What are we going to look at? We're going to look at how to set up a company. We're going to be looking at the main benefits of setting up a company, why it's more important now than ever given the recent tax changes in the budget. And thirdly, I will take you through a case study on the screen where we look at worked examples of a one property portfolio in your own name versus a company and a full property portfolio in your own name versus a company. So let's get into it. How do you set up a UK limited company? There are three ways to do this. You can do it via Companies House. On your own, you pay a small fee. Very easy to do, but you need to make sure you get the right company code, which is for a company that is trading in properties. Second way would be to work with a traditional accountant, someone who sits in an office and can do this for you. You'll pay them a small fee to do that. And thirdly, you could use what we would call a challenger company, of which there are more and more nowadays, such as a Taxd or a GetGround, who call themselves software companies, so it's all done online via a platform. You sign up, you pay their subscription fee, and they will do it for you. So you've got the least expensive, would be doing it yourself on Companies House. Then it would be the software tools, then it would be a traditional accountant. We have done a recent podcast episode with Arjun Kumar, founder and owner of Taxd, talking about how to do this, plus some of the benefits. So if you'd like to watch that full podcast, 25 minutes, then there'll be a link down below in the description. In the autumn budget, Rachel Reeves announced that there would be changes to taxes that will impact tax rates you pay if you own property in your own name, namely a 2% increase on income that comes from property if it's owned in your own name. So therefore, now more than ever, and we're going to look at some of the benefits next, now more than ever it is important to use a company structure to own property. And there's only perhaps one instance where it is not more efficient to do so, and we'll look at that at the end. So what are the main benefits of owning property via a company? There are many benefits to owning property and building a portfolio via a company structure, but I'm going to talk through the 3 or 4 that are the most important and that we find resonate and relate to our high net worth clients overseas the most. First and foremost would be MIRS, that's Mortgage Interest Relief at Source. That means that you can still deduct your mortgage cost off your tax bill. Now, you used to be able to do this in your own name up until about 2016, 2017, I think, and then it was phased out, and now you just have a 20% credit. Whereas in a company structure, you can fully deduct that mortgage cost off your tax bill, which leads to a massive saving depending on your structure and the amount of properties, which we'll get into. Secondly, legacy planning. Many of us are building portfolios, not just for ourselves, our pensions and income, but for our daughters, our children, our friends and family, so that we can leave them in a better position than ourselves. And doing this via a UK limited company is a much more tax efficient way to pass over holdings in a portfolio versus if you own property in your own name. 2 examples. You can structure it so that children or loved ones, whoever you want to pass it over to, can become shareholders in the business. They don't necessarily get income, you can maintain that income, but they can be shareholders, setting it up for an efficient legacy handover. Secondly, stamp duty on buying shares in a company, if they were to buy in or you were to sell them to them, is only 0.5% versus 7% plus with property. So you are saving a lot of money in tax there. Third and foremost would be the tax benefits. We've touched on the MIRS, but I think there's 3 more points worth covering. First one is director's loans or using director's loans. Any money paid to the company to buy property can be taken back tax-free as a repayment of director's loan. So as an example, if you've got a £500,000 portfolio and £150,000 of that is deposit that you put in, the rest is mortgaged, then you can take £150,000 back out tax-free. And it doesn't matter when you do that, you can pay yourself a monthly income, and that would be tax-free if you are returning the director's loan. Second point would be the fact that you can charge yourself interest on your director's loan, which again is a tax efficient way of getting money out. The only stipulation there is you can't charge 20% or 10%, it's got to be in line with market rates. So at the moment, 5-6%. And lastly, once you have paid your corporation tax within your business, assuming you are living outside the UK, you can remit money tax-free and based on the tax rules of the country you are residing in. It's different if you're in the UK, but as we are dealing with expats, we're talking about the expat situation. So who should use a company structure? It used to be very dependable on your situation, but more so now, especially given the recent budget changes. In our opinion, there's only really one situation where you could look at buying in your own personal name, and that is if you are just planning on buying one property. Everyone in the UK, I should rephrase that, if you're a UK citizen, UK passport holder, an EU national and various other countries, if we've got double taxation agreements with them, you get a UK personal tax-free allowance of £12,570, doubled if you're married. Let's look at a single person example. So you have £12,500 tax-free income. Therefore, one property earning around £1,000 a month will take you up to that level. So that if that is your only goal, is to buy one and continue to live overseas, then maybe you can buy it in your own name. If you're going to move back to the UK and you're going to be working, then you want to ring fence that income. Therefore, you should do it via a company. And in most other instances, apart from the one example, it is more tax efficient to own via a company for the director's loan, charging yourself interest, legacy benefits, and MIRS. And this compounds the more properties you have. So let's have a look at a quick example of a one property portfolio versus a full portfolio in your own name and in a company name. Here we can see a simple working of a one property portfolio owned in your personal name versus in a limited company. And that goes back to what we were just talking about if you're only looking at one, then maybe a personal is the way to go, versus a full property portfolio. And obviously there's a sliding scale in the middle here. So we'll go through these, we'll talk through them briefly, and then we'll look at some of the allowable expenses, and hopefully it'll help you understand what might be the best route for you. So one property portfolio, we are assuming £1,000 a month, £12,000 per annum. The total mortgage expense is £8,400 in this instance. So total income £12,000, £8,400 is your mortgage expense. You've got a tax-free allowance of £12,570. Therefore, you are below that, no tax, one property in your own name. In the company structure, same setup, same income here. You've got the same mortgage interest, but you can deduct that off your tax bill in the company name. So you're left with a taxable amount of £3,600, up the basic corporation tax, which is up to £50,000 a year, 25% thereafter. You are taxed $684. In reality, this would probably be lower or no tax. So I know the first year I had my property company with one property in it, I was actually negative 600 something. So the government owed me money, not that I would ever see that. And that's because you are allowed to deduct all of these expenses over here. So in reality, it would be lower than that, but this is a simple example. So let's have a look at a full property portfolio. Same principle, £12,000 per annum. And the mortgage interest is the same, $8,400. So you've got a total income of $48,000, mortgage expense of $33,000. So your taxable amount after your personal tax-free allowance is $35,000. So that's minus your $12,570. In your own name, you do have a 20% credit, so you can deduct 20% of the mortgage expense off your tax bill. Here it's $6,000. Therefore, your taxable amount is $28,710. That's in the basic tax bracket. So at 20%, that's £5,700 odd. In the limited company structure, the exact same figures, but here you can deduct your whole mortgage expense off your tax bill, which means you're left with a taxable amount before any of this, so likely lower again, but simple figures, of $14,400, therefore tax at 19% of $2,736. So you can see the company structure as you build a portfolio does become much more tax efficient. And if you add in the other benefits, the legacy planning, the tax efficient returning of money, those sorts of things, then it does start to create quite a compelling case. So there you have it. We've looked at how to set up the company. We've looked at the benefits of doing so, why it's more important now with recent tax changes, a case study and a worked example of who could potentially use it, As I say, if you'd like more information, we've got a full podcast episode we did on this with Argent of Taxd, or reach out and we can give you slightly more personalized information based on your situation, and or put you in touch with the tax partners we mentioned at the start who do our own personal portfolios and those of our clients. Thank you.